Coke lost millions of dollars in yearly revenue after refusing a loan to Marriott. But Marriott tried to strong-arm Coke to lend them $100 million at below-market interest rates. These are 3 business lessons that I learned from this case and applied to my startup to avoid big business fallouts. What's up, everyone? Your favorite CFO, Logan here from Forecaster. If you're a founder looking to learn from stories of other founders, this video is for you. Today, I'm going to be talking about an incredibly unique set of events that unfolded in 1991 between Coca-Cola and Marriott, and the fallout that occurred as a consequence. I'm also going to be going through my takeaways from these events and how we can practically apply learnings to our own businesses and level up as founders. But first, do me a favor and hit that subscribe button so that I can bring you more CFO insights on what's happening to the venture market and interesting business stories from the past, like the one that I'm going to be covering today. Let's dive in. The early 1990s were challenging for the Marriott hotel chain. According to the Washington Post, Marriott was hit by a slump in tourism and business travel and a surplus of hotel rooms, and the company suffered its first quarterly losses in 28 years during the fourth quarter of 1990. Now, Marriott had been laying off employees and stopped developing new hotels in an effort to conserve capital. In early February, it said that it had lined up $400 million in additional bank loans, which eased stock traders' fears that the company was running out of cash to pay its bills. One of the major expenses in operating a massive hotel chain like Marriott is a non-obvious. It's soft drinks. Marriott had 639 hotels and 2,300 food service accounts such as hospitals and university cafeterias, and the company was believed to be one of the 10 largest buyers of fountain products in the world. The supplier of these soft drinks for Marriott was Coca-Cola. In fact, the two companies had been doing steady business together for over 20 years. But things changed in 1990 when a senior executive of Coca-Cola says that the soft drink company lost the massive contract to Marriott after Coke refused to lend Marriott as much as $100 million on favorable terms at below market interest rates. You see, negotiating with vendors is really common in cash crunches, but Marriott really went above and beyond here. Charles Fournette, a senior vice president of Coca-Cola, said that they in effect were asking us to become their banker. In an effort to try and inject capital into the business during a hard time, Marriott used the power of their massive business as leverage to strong-arm Coke into giving them a massive loan that they otherwise would not be able to get. This was a proposal that made Coca-Cola very uncomfortable, and they refused to do the deal. Coke's largest competitor, Pepsico, seized the opportunity and stepped up to the plate. Pepsi agreed to lend Marriott between $40 million and $50 million, and as a result, Marriott gave Pepsi all of their business and canceled their account with Coke. So to this day, you will only find Pepsi products in the vast majority of Marriott locations. This was a really complex and polarizing situation, which makes it a really interesting case study to dig into. Whether you're Team Marriott or Team Coke in this story, there are plenty of things to learn. And here are my top 3 takeaways after watching things unfold. My first learning here is that sometimes you have to be willing to go above and beyond for your largest clients and do things for them that you otherwise would never do for smaller clients in an effort to keep them happy. In the case of Coke, keeping their largest client would mean shelling out hundreds of millions of dollars. Coke wasn't willing to meet their request in this case, which led to millions of dollars of lost revenue. In an effort to stay ahead and avoid these surprising outsized requests, here are 3 things that we can do in our own businesses to keep our largest clients. Number 1, we can meet with them monthly to discuss their account along with just general routine business operations. In the case of Coke, getting ahead of the cash flow problems with Marriott and offering proactive ways to ease their cash burn might have led to different results. Number 2, we can be transparent with our largest clients if and when it becomes necessary. I have to wonder whether or not Marriott would have acted as negatively if Coke would have communicated that this was a deal that they couldn't financially pull off at that time, if in fact that was the case. A little bit of humility and transparency really goes a long way in business. Number 3, we can try to get to a point where your human relationship with your largest clients runs deeper than dollars and cents. Trust is an element of business that's really hard to put a price tag on. And in the case of Coke and Marriott, they had a 20-year business relationship. You have to kind of wonder about the quality of that relationship though, given how quickly Marriott dropped Coke for a lower interest rate on financing. Perhaps if they had spent more time building trust with their partner, things would have ended differently. My second takeaway is that you should always be opportunistic in business and ready to pounce on opportunities when something incredible opens up. Now in the case of Pepsi, they had their eye on this unfolding situation and they got into a position to pounce as soon as they were able to do so. Now here are 3 things that we can do in order to make the most out of situations such as this. Number 1, we can keep a war chest of cash for large unexpected opportunities. In the case of Pepsi, they happened to have cash to step up to the plate, which led to a massive expansion in revenue. Number 2, we could stay up to date on all major players in our spaces, whether they're customers or not. Now in this case, because Pepsi already had a good relationship with the Marriott management team, it was easy for them to have conversations with the higher ups very quickly quickly in order to snag this contract. And number 3, you need to have strong bankers lined up, giving you the ability to act quickly and get good financing if and when opportunities come up. In the case of Pepsi, they may have been willing to draw a $50 million line from a bank at a higher interest rate, lending it to Marriott at a lower interest rate, and using the increased revenue to fund the losses from the interest rates. My third takeaway is that business doesn't always boil down to dollars and cents, and sometimes you have to be willing to stick to your guns if you feel as though you're being taken advantage of. Here are 3 things that we can do in order to maintain integrity in our business. 1, we can identify core values for your business. These are values that you put ahead of profits. And in the case of Coke, if they felt as if they were being taken advantage of, they would be willing to lose revenue in order to keep the integrity of their core values. Number 2, we could try to only work with people that adhere closely to our core values. This whole situation could have been avoided if Coke identified early that Marriott was not a good cultural fit for their business. And number 3, we can make sure that everybody that invests in our company is comfortable with your core values and what adhering to them could possibly do to your business. This way, if you make the decision that Coke did and stick to your guns, your investors are going to stay in your corner. So those are the 3 biggest learnings that I took from the story of how Coke lost the Marriott account to Pepsi. But what were your biggest takeaways? Add your thoughts in the comments below, and I'd also love to hear whether you're Team Coke or Team Pepsi after hearing these details. And if you want to hear more of a CFO's take on current events in the venture network, I'm going to be dropping a ton of free content here on YouTube. So go ahead, like the video, subscribe to my channel, and maybe even hit that bell. And if you want to learn more about fundraising and how metrics and finance can help you run your business better, head on over to Forecaster's website to get in touch with a member of our team. Until then, keep building. We'll talk soon.